Okay, 11 o'clock, we can get going. So my guest this week is Alex Crook from Bankers Investment Trust. So we'll be talking to him in a bit, but obviously, as usual, we've got some news to have a look at first. And thirdly, obviously, I'm going to be talking about the proposed merger of HICL and TRIG, Foresight Solar, and also Murray Income. So we'll start with HICL and TRIG first. This is a HICL chart. And obviously not that pretty. And you can see the share price diving off at the end there after the announcement of the deal. And quite a wide discount now, so about sort of going on for 31%. And that is the TRIG chart. Also not pretty. And there is a small uplift at the end, but it's really not very big. And that's still on a 31.9% discount. So the deal that they've announced is for HICL to buy TRIG, but it's structured as it's the Guernsey equivalent of a Section 110 scheme. It's something we talk about all the time here. So basically, you take the NAVs of the two companies, you knock off the costs, and then you smash them together. And they're basing it on the NAV as at the 30th of September. So we actually know what the ratio would be, which is there on the screen. If you're a TRIG shareholder, you also get a cash exit option, but only for about 10.8% of the company. And there's no cash exit option if you're a HICL shareholder. And we'll come on to why that is wrong later on. And that cash exit is going to be done at a 10% discount to the NAV. So very roughly, 250 million quid at a 10% discount means there's 27.8 million of uplift to the NAV. And that is split 50-50 between the HICL and TRIG shareholders to help offset some of the costs of doing this. And the other sort of positive thing on this is that Sun Life would buy £100 million worth of HICL shares in the secondary market after the deal to try and help kind of steer the ship a bit. And they say that they've talked to large shareholders and had positive feedback from them. Which a lot of people are finding quite surprising, but nobody's come out and denied it yet. So obviously the manager stays on as the manager of the combined portfolio because InfraRed run both funds. The fees are tiered as you might expect, and they're slightly lower. They're based on an average of market cap and NAV, which isn't ideal, but this seems to be the route that the renewables industry has gone down. Obviously, if it's on a 30% discount, that makes a big difference. And so that works out, they reckon, at about an expense ratio of about just under 1%. And Res, which is the sort of other bit of the manager, will stay on as an operations manager, and then it's got a tiered fee as well. And it's getting compensated as though that 250 million cash out hadn't happened. So for the first year, so its NAV, its adjusted NAV is slightly higher than it would be otherwise. And they are both on 3 years' notice, which falls to 2 years' notice when we get to April 2030. Now, what the smashed fund is going to be is slightly different. So they're going to target growth, and we'll look at that a bit more in a second. And they're looking for a 10% total return on NAV. Because obviously the TRIG yields a lot higher than the HICL one, to kind of sweeten the whole pot, they're going to put the HICL dividend up from 8.25p, where it's been flat for ages, to 9p. And they said it'd be covered about 1.1 times. And they also say that there's a kind of be a progressive dividend policy. So you could see that dividend rise over time. So say HICL's been flat for 8.25 for a long time. We'll go up to 9, could rise from here. One of the classic things with mergers is the idea that some directors lose their jobs, but here that's not the case. So you go to a board of 11 members. Everybody keeps their jobs, but they will reduce the number of directors over time. There's no title for that. There's no target number, nothing like that. And they are motoring ahead with this, so we should see a proper circular announced soon, meetings in December, and aim to complete it within the first 3 months of 2026, if all goes to their plan. Now, I said that the strategy is shifting a bit. So really what they're trying to do is bring in more kind of growth into the mix by investing in things at an earlier stage. So actually developing projects and that sort of stuff, which means higher risk, obviously, but higher potential returns, but lower cash yield up front. So there's kind of shift from what they do normally now towards that kind of growth type thing, which is something actually that Octopus has been doing for a while. They've been trying to develop more projects and push returns on that way. I don't really have a massive problem with that. But obviously you have to watch what the impact is on dividends. And you also, it does represent a sort of change of the risk profile for investors. So especially if you're a HICL shareholder, where the risk looked relatively low, you are going to be taking on a bit more risk than you were. And then there's also a reference to having more debt capacity, which kind of implies that they're thinking about using that. And again, some people will be a bit antsy about this, as understandable. So they've got about 500 million quid's worth of drawings on their revolving credit facility, which is floating rate. And they're going to try and replace that by doing private placements of debt. So that will hopefully bring the cost of debt down, but at least it fixes it for the future. But what they sort of indicated here is that they could double the amount of debt that's in the combined portfolio, which again, I think most people would be a bit worried about. It becomes a sort of pan infrastructure renewables fund, really quite complex in terms of what it's got. This is just smashing the two together. This is very roughly based on the fact sheets. I probably haven't got the maths exactly right, but this is the sort of thing we're looking at. So lots and lots of different segments of infrastructure and lots and lots of different countries, all kind of OECD and developed, so no kind of emerging market risk there. Still a big bias towards wind. So you can see that's about 35% of the total. And if you're a HICL shareholder and you wouldn't that keen on renewables, that's obviously going to be a bit of a worry. And then a whole raft of other things. So you'd expect that if they're shifting more to growthy things, then the old-fashioned, if you like, PFI type stuff will run down, I think. In terms of the new projects, there's a whole load of different things, and I didn't put that chart in here because it's just too complicated. But there's loads and loads of different bits of infrastructure. Now, on the cost side of things, these things don't come cheap. They're giving each other an indemnity if one of them backs out of the deal, whatever reason. What I've heard is there's 30 million quid's worth of fees going to the advisors on this. And we're not talking about the normal brokers. This is one of the things that I don't understand. We're not talking about normal brokers in the sector. This is Goldman Sachs and Rothschild people that sort of seem to sort of dive into the sector only when there's a big ticket on offer. And don't necessarily know what's going on otherwise. I don't necessarily know the investors. I just find it a bit strange that happens quite a lot, but there we go. So big, it's not a cheap thing to do, slightly offset by this NEV uplift that you get from buying back the stock at 10% discount. The TRIG buyback program is going to be suspended because all the maths has been done based on the situation as it was when they announced it. But the HICL buybacks will carry on going. But they're not coming up with anything to tackle those enormous discounts. So there was a Q&A session at the end of the analyst panel, which asked a lot of questions that I thought were quite relevant here. First one, and I think is a common one, is if HICL wanted to do a deal where it wanted to grow, and it's cast around for things to buy, there are lots of things that it can buy that are trading at a big discount to NAV. And if it was trying to maximize the uplift for its shareholders, if that was its only focus, you could probably pay a lot less than NAV for a book of assets. So why do this merger on a NAV for NAV basis? It doesn't really make sense from a HICL point of view. Secondly, given that you've got a completely different risk profile in the new vehicle going forward than you have at the moment, you're much more likely to be unhappy with the new portfolio if you're a HICL shareholder than if you're a TRIG shareholder. So they've rationalised the cash availability for TRIG on the grounds that there are a few people that hold TRIG that wouldn't like the new mandate. I think it's equally true, perhaps more true of HICL. So it just seems wrong that there's no HICL cash exit. And the chairman also said, the chairman's answer to this would change of risk thing was just basically you can't please every shareholder, which I think is a bit weak. Now, the thing that we were banging on about last week was the change to the indexation of subsidies, which does take a chunk of money off the TRIG NAV. And they say that was reflected in the terms of the deal, even though it wasn't reflected in the 30 September NAV, which is what they've used. So I'm not quite sure how that works. But that's what the board said. I think there ought to be another adjustment, but there we go. And when people ask, we're doing a big deal, normally you look for cost synergies. Are there cost synergies? No. The answer is straightforward. No, there aren't any cost synergies here. You get slightly reduced overall fees because of the tiered nature of things, but nevertheless, there are no big cost synergies. There's nothing going to be taken out here. Whereas there would have been if HICL had bought an infrastructure fund or if TRIG had bought a renewables fund, which would have made more sense. So you could have taken out, a whole load of stuff. The TRIG board said it was attracted to the deal because the earnings for the combined vehicle would be more resilient than the existing TRIG earnings. But there's an implication there for HICL that it's going to be less resilient with TRIG involved. So that doesn't really suck up either. And there's genuine questions. I think it's just too appalling to contemplate, but we could get a government that comes in and scraps subsidies altogether. If that happens, then the value of TRIG that HICL's acquiring would be an awful lot lower, and HICL shareholders would have lost out big time beyond what they're going to sort of lose out on already. And there's no mechanism to compensate them for that. And there's a general question, well, I guess I've alluded to already, why can't they just do these deals, separate deals, and grow themselves? Why can't they go after growth opportunities if that's what boards want to do? They're already big companies, they don't need to be bigger. You can't really have a liquidity argument for doing it because these are already, 1.72 billion market cap companies. It doesn't really make sense. So a lot of people are unhappy. I think it's understandable. The people that sort of really jumped up and started shouting about it first were CG Asset Management because they are shareholders in HICL and not in TRIG, although they did hold TRIG and they sold it in the summer before this happened. And it's been pointed out that one of the things that's achieved here is that TRIG was supposed to have a continuation vote next year and now won't have one. So it's got away with that. So it just all smells a bit. I'm really not happy with the thing. I think there are very good reasons why HICL investors should vote against this. If you're a TRIG investor, it's probably the best deal you could possibly get, and that's the whole point. But the reason why it's so good for TRIG investors is because it's bad for HICL investors, and you're really, one is being compromised with the interest of the other, and it shouldn't be that way around, given that HICL's buying TRIG. So there we go. Foresight Solar. So another disaster there, and you can see the share price going down more recently, along with the NAV. Really not great. Not very big company now, only 362 market cap on a 35 discount, but a really big yield. Now, what we want to talk about here is the latest quarterly NAV announcements, and it's not pretty at all, as you can see there. So the dividends sort of match their time value. That's kind of what you expect. Actually, power price forecasts that have been chip away at. They didn't come down again, which is good. So that's kind of helpful. There were some particular problems with some of the projects I'll talk about in a second. There's a big cut to the forecast value of renewable energy certificates. The sort of things are basically, if you're a fossil fuel power producer, you have to buy these things. And apparently, so I've had a real dig around that, there is a sense that so much more renewable capacity is coming on, especially with the latest couple of auction rounds that the government's done to find this certificates built, obviously, that there's going to be an awful lot more of these REGO certificates around, and that means that the price for them will go down, and that will make sense. So that's going to be a thing that's probably going to be common to most people. Inflation is actually running a bit ahead of where they were thinking it was going to be, so that's been a positive thing. But there's some discount rate adjustments. So basically what that is them cutting valuations of some things in the portfolio, and we'll come on to why in a minute. And then the other big one in here is this tax review adjustment, so 3.6p off the NAV. So what was going on underneath all of that? So solar portfolio, they had very good radiation, so that should have been that they had a bumpy year in terms of generation, but there were a lot of outages where they lost their connection to the grid, and that's not their fault. It's not something within the control. It's a national grid problem, or the equivalent in other countries. But that's not great, and that's just sort of something that I think needs to be improved generally. They've been trying to sell a portfolio of Australian assets, and there just haven't been any buyers for the price they wanted to sell on that. So that's a bit worrying. So they have written down the value of those to reflect the fact that they're not sold for the price that they're looking for them for. And they're still wondering, they still want to cash those in. So they're looking at what ways that they could do that maybe. And then also there've been trades for Spanish solar too, and they've been coming in at prices lower than had been hopes as well. This tax thing, I don't really understand, and I talked to a few people, and nobody seems to understand where it's come from. It's sort of something around just the assumptions that they were making were a bit optimistic, and they had chats with HMRC, and HMRC didn't like it. But whether it's just unique to them or not, we just don't know. But given that nobody else seems to know what's going on here, I would think it probably is unique to them, because otherwise HMRC would be talking to some of the other companies. We will see. They said they quantified what the hit would be to this indexation consultation, and it's really quite chunky. So in the worst case scenario where the government just pretended that it had been using CPI all the way through rather than RPI, it would be a 10% hit to the NAV. And you've watched back the shows before, like basically this is just a terrible idea, and it would just basically raise the cost of private finance for everything that the government wants to do in the future, and end up costing them more money than they save. I think it's just a really daft idea. So with all of this going on, the chairman really sounded of a note of disappointment. They are looking for a deal. I think that is like to come probably next year. We will see what happens, but what the price is for that, we will see. It did occur to me, because there's a lot of stuff getting written down here, whether they were sort of basically window dressing it a bit to say, well, look, this is the real value that we think it is, and come and pitch us, for a price around that. But we'll see. In the meantime, they're going to carry on buying that stock. And then let's have a good news story for a change. Murray Income, which we know that it's been suffering for a long time, and it's because it had a quality focus. They've been quite good about buying stock and keeping the discount down. And then when they announced that they're going to do something, the discount narrowed a bit. And they said that they're going to put Artemis in as the manager. So it's a straightforward swap of Aberdeen to Artemis. The Artemis team, I quite like. It's kind of weird that, given how good they are, that they haven't had a investment trust to run before. But this will obviously solve that issue. And they just had this pretty consistent good returns for a long time. There's basically no real change to the strategy of the fund, because it's the same objective, same benchmarks, same giving policy. They're going to carry on growing the dividend. They're going to carry on buying back stock. There's nothing really different there. And so because of that, there's no need to offer a vote for shareholders, and the board felt there was no need to offer a cash exit because they're going to be buying back stock anyway. And I think I agree with that. It's not something so radical and scary that people want to sell. Although if you did want to persist with like a quality approach, what I've said when we commented on the deal was that best thing is just to switch into either to even income and growth, which is same manager, quality style, or something like Finsbury Growth and Income. And you tell from the performance of both of those that these are qualities been suffering for a long time, and the part of the argument might be that it turns, but we'll see. Obviously, it comes with a lower fee, which is good news, and based on the low market cap and NAV, which is obviously good news. And Artifice is going to waive the fees for 9 months because that covers the cost of doing this deal, which are not that big anyway. And the notice period is only 3 months, with the contrast between that and the notice period that HICL and TRIG are prepared to hand out is just bonkers. But there we go. So tick, I think. The reason it works, or it seems to have worked so far, but it's got a long track record of working, is they're not pigeonholing themselves as value or growth or quality or momentum or anything like that. So they're trying to be pragmatic about stuff. They're not just buying what's in the benchmark. They're not just buying the big income generators. Everything they're kind of looking at, they're forecasting out 5 years. They're looking at cash flow generation. They're saying, can that cash flow sustain dividend growth? And if it can, it'll make it into the portfolio. And that all makes complete sense to me. So that's the track record. They're going to do a shareholder presentation. I've seen an analyst one that is not up on the website. So there's like a screen I was going to have to catch, but they did show a chart. So look out for it when they do the shareholder presentation. Basically, just show that how many rolling periods they've outperformed in, and it's very, very rare that they've underperformed. Because it's not skewed to a particular style, there may be times when it's not top of the pile. But to be top quartile over most periods is actually quite good news. So I like this. I think it's a good result for my income. Maybe it's just in graph form there. So good luck to him, really. So that's enough for me. There's loads and loads of comments come in here. Is HICL a buy if the discount's so wide? I think HICL's definitely a buy if they turn around and say we're not going to do the deal. Even despite this kind of break clause thing, it's not that big in a great scheme of things. So that would be taken as a positive. And obviously, one of the things that I'm thinking of is that by doing this, if shareholders reject it, they basically put both of themselves in play. So it would just be interesting what happens. Some conflicts of interest we can't see. We don't know. I'm not going to go into that. It's just like yeah, probably not a good idea. Yeah, that's probably it. So we'll stop there.